10 years ago, everyone knew the stock market was risky and residential real estate was a safe investment. Back then, no one would have borrowed to buy stocks, but people were using no money down loans to buy condos. It was a sure thing. Well, now we know it wasn't. It turns out that for many investors, residential real estate was more than risky than the stock market. So how did we get it so wrong? It may have something to do with the internet. Starting more than a decade ago, we began using online tools to monitor our investment portfolios. Instead of getting a monthly statement or searching the stock listings in the back of the business section, we were able to instantly see our entire portfolio every day. And what we saw shocked us. Stocks soared and then plunged with churning frequency. If the swings weren't enough, we were assailed from every side by 24-hour financial channels, websites, and radio shows shouting confusing and contradictory advice. Most of us hated this emotional roller coaster. By comparison, our homes seemed like such a safe investment. That's not to say that their value didn't fluctuate. It did. It's just that without the instant reporting provided by the internet, we couldn't see what was going on. Experts call this information risk premium. Investments that are actively traded and reported on feel much more risky because we see their daily fluctuations. By contrast, less visible assets like hedge funds or real estate may seem less risky simply because there is less daily attention placed on them. But visibility by itself doesn't tell you anything about the relative riskiness of an investment. All things being equal, lots of market data combined with easy trading may turn out to be more risky if it causes you to deviate from your plan and turn fluctuations into real losses. So what does this mean for you? First of all, relax. Don't focus on day-to-day fluctuations. They are almost always meaningless in relation to your long-term goals. Second, spread your investments over multiple asset types. And third, when evaluating the relative risk of a given investment, trust your plan and not your gut. And remember, what matters most is not the risk you see, but the risk you take.